life insurance. We're going to give you the pros and cons to this. First piece we recommend, probably in every single video, pick one of the big four, right? 4 major mutual companies, Mass Mutual, Guardian, New York Life, or Northwestern. They've paid the highest returns. We have proof of it. When you look at major banks and corporations, they gravitate towards those carriers. There's a reason for that. You've got illustrated in actual performance. But let's just go through the basics here of exactly how whole life insurance functions. We have a premium. This premium is level for the life of the policy, meaning it does not increase on us. One piece to emphasize here is because it's called whole life insurance, that does not mean that we have to pay into it for our whole life, right? We can design an account where literally we stop in 2 years, 5 years, a certain age. We stop and go, adjust our contributions. We're not just locked into a boring premium forever. We have a death benefit, which you'll see gradually increase over time. Quick side note, death benefits on all life insurance policies are always paid out 100% income tax-free, regardless of the type of policy. All right, and then we have our cash value. Right, again, this is what people are interested in. The whole life, we'll see it go nowhere but up. And we'll touch on one point here, that if everything is set up properly, meaning we designed the account properly, we're positioned with one of those big four, what you're likely going to see at net is somewhere in this neighborhood, the net returns, not the gross dividends, the net returns between 4 and 6%. We've got some historically that have been a little bit stronger, but those lived back in the 80s with double-digit dividend rates. Undershoot it. If it comes out higher than that, we'll be happy. So a couple bullet points here in relationship to the cash value. Firstly, there's no risk, right? And what this means is that the funds are in no way, shape, or form invested in the market. So it's free and clear of the stock market. How we actually earn interest on these accounts are 2 components. You have a guaranteed rate of 4%. However, a company will credit a surplus in addition to that. The guarantee plus the surplus gives us a total dividend rate. Right? If we've heard the term dividend paying life insurance, this is it, right? Total dividend rate. But what's important to note, the guarantee plus the surplus gives us the dividend. With those top companies I'd mentioned, you'll see this is for 2019. Rates range from about 5 to 6.4%. One quick tip, don't buy a life insurance policy based off of an illustration. They all fluctuate, especially as time passes and their dividend rates do. All contributions are made with after-tax dollars, meaning we cannot deduct our payments like we could with a 401k. You can set it up in a qualified plan, but then it's going to work like a 401k and the tax-free benefits out the window. Which leads us to our next 2 points. The growth is technically tax deferred. But if we do everything properly, and I always phrase it like that, we can access it 100% tax-free. Right? And why we mention that, right? If we do everything properly, we can get to it tax-free, is because this is marketed so heavily as tax-free, tax-free, tax-free. Yeah, if I do everything right, it's tax-free. But if I trigger a MEC, if I lapse with a loan on it and there's a gain on the policy, there's things I can run into. We've got other segments on that. that can result in a taxable event. So if we do things properly, it remains tax-free. A couple bullet points there. The last point to touch on is we do have a unique loan or borrowing feature, which really ties into the whole idea of the infinite banking concept. Right? If we set it up right, this policy, in particular your cash, is going to work very similar to a line of credit, in the sense that if you've got $100,000 in there churning at 5% a year, if you just let that sit and grow, or if you pull it out, you'll continue to earn 5% as if it never left the account in the first place. We've got other segments on that. So let's look at an example.